Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
I'm Whitney, host of the Real Estate Syndication Show. Every day, I'm interviewing experts that will help you to successfully invest in or grow your syndication business. Hit the like and subscribe button so you'll be on track to learn from the best in the industry. Hey guys, it's Whitney. I wanted to take some time to introduce you to my good friends over at passiveinvesting.com. They're a national private equity real estate firm based out of the Carolinas. They focus on acquiring institutional quality apartments and self-storage facilities. They do this with private accredited investor funds. They have a portfolio of over $700 million in assets and control over $250 million in equity from their investors. Passiveinvesting.com makes it easy for you to start investing in real estate without all the hassles. They even have an average 62% repeat investor rate in each offering they put together. They even have a real estate debt fund that offers hard money loans to local fix and flippers across the U.S., which currently has a 0% default rate. To help you learn more, they've put together a free passive investor guide that outlines the 7 red flags for passive apartment and self-storage investing. Visit passiveinvesting.com/red flags to download the PDF now. That's passiveinvesting.com/red flags.
This is your daily real estate syndication show. I'm your host, Sam Rust. With us today is Neil Bertrand. Neil is a 25-year multifamily veteran who's operated across all multifamily asset classes and types. He's currently a co-GP in 433 units and is a part of the REIT group, which is developing $1.4 billion in new mixed-use developments across Texas and specifically focusing in the Austin MSA. Neil, welcome to the show. Thanks for joining us today.
Sam, thank you for having me.
So as I was doing some background research on you, Neil, and trying to make sure I was prepared for this interview, noticed that you went to Liberty University and you graduated with a Bachelor of Science in real estate. And often a lot of people who are in the real estate space didn't necessarily point that direction initially as they started their career paths. Like my degree was in business management. I went into sales and then migrated towards real estate. And that arc is a somewhat familiar story. You might be more unique in that it seems like you knew what you wanted to do from a pretty early age. What sparked your interest in real estate and what led you to get your degree in that?
So it's an interesting story. When my wife and I met, I was actually a semi-professional musician and doing a lot of touring. So you can't really sustain 28-year marriage if you live on the road 10 months out of the year. So I decided to look for something else. My wife was actually already in property management and suggested I give it a try. And I did. I went to work almost immediately with one of the largest companies in the country at the time, which was Letic, who are now called, I believe, Involve, and just really gravitated towards the numbers side of things. You know, and I've always loved the architecture of apartments and office buildings, and it just seemed like a right fit. And there's so many different avenues in real estate. And that if you want a career, I mean, there's acquisitions, there's asset management, property management, there's the lending side. I mean, there's so many different avenues to pursue.
Oh, that's fascinating. I have to ask, what kind of music did you play, or what instruments did you play?
My main instrument is bass. I do play some piano and very little guitar. And at the time, I played whatever you hired me to play. So I was in heavy metal bands, funk bands, bluegrass bands, wherever the money was.
Oh, that's fantastic. Well, I'm guessing the pivot to real estate has served you well.
Yes, it has.
Fantastic. So as I look through your background, Neil, you've worked for 4 different top 50 NMHC real estate companies, and you've been in a variety of roles. You've been in asset management, you've been a VP of acquisitions, you're involved in development, you've worked in conventional, senior, LIHTC housing, all sorts of things. You've worked on all sides of the pie, I guess is what I'm getting at. What is the single most important? And a lot of our audience is passive investors. They're trying to figure out how to evaluate sponsors. When you look at all those roles that come together to create a successful syndication or a successful project, if you could pick out one, what would it be? Why?
I think probably the most important thing that determines the success of a property is the underwriting. It's not really overlooked, but there's two types of underwriters, 2 types of underwriting models. The ones that are built for speed. So you can go through as many deals as possible, kind of like a back of the napkin approach. And then there are the underwriting models that take about an hour and a half to complete all the data entry and then start tweaking the numbers. The difference with those two is speed may allow you to go through more deals faster, but the more detailed underwriting, when you are drilling down into every aspect of how to make that property successful, why it works, why it doesn't work. I mean, right down to the unit mix compared to the comps. And, you've got 23 2-bedrooms, they've got 48. You can be a little higher on your rents than they can because their availability can fluctuate and be wider. Definitely the underwriting, because that's where it really all starts.
And underwriting is a really broad subject in and of itself, Neil. There's so many, as you just alluded, there's two main different schools of thought. There's speed versus thoroughness, maybe, if we were going to highlight one aspect. But there's a lot of assumptions that go into underwriting. And I think the job of a good underwriter is to flesh out those assumptions, be able to back it up with hard data, and introduce a level of conservatism into the overall business plan. You're obviously underwriting deals both as a career and also on the side. You're a co-GP and over 400 units in Texas. When somebody gives you a model and says, hey, Neil, I have this project, I'd love you to look at the underwriting. Where do you go first? What are the first 2 or 3 things that you look for that tell you a lot about the underwriter?
The first thing I'm going to look at are the sales comps accurate and are the market comps accurate? When you're comparing the sales comps, and it's going to depend on where you are in the age of the asset. Have they chosen similar aged assets, similar sized assets, and how recent were those sales? Our industry and real estate as a whole fluctuates greatly. I mean, literally just 3 to 4 years ago, I was submitting LOIs on properties built in 1996 at 165 a door. Now I'm doing it on assets that are built in 1984 for 165 a door. So that's how fast it changes. On the market survey side, and keep in mind, I mean, with my property management background, kind of gives me an advantage, right? Because I know immediately what to go look for. On the market side, is the subject property really hedged against accurate comps? And where do they place the subject property? Because really, the property you're underwriting, you always want it in the middle. You want to hedge yourself against a property that's better than you and can command higher rent. And then you want to hedge yourself against properties that may not have quite the amenity package or the level of upgrade. So you get a good balance. And then I want to look at, on that market survey, did they just pull a CoStar report or a Yardi Matrix report and drop those rents in? Or did they go to the website and get the actual rents? Because there's always a discrepancy there. And then have they plugged in a blanket rent increase across the board? That right there, if you have a 200 unit property and you say, well, the market is, these rents are $75 below market, I'm just going to drop in 75 across the board, you've automatically blown your underwriting, because what if out of that 200, 75 are already fully upgraded units at market rent? You just plugged the $75 increase on top of that. So now your return skewed. The other thing that I will go and look at is the performance assumptions. And even myself, having my background in property management, I always stress test the deal and really just kind of say, okay, let me push on the expenses a bit, because everything's kind of variable until we go in, we do our due diligence. But I also want to see what they've got plugged in for income and expenses, right? Really kind of a rule of thumb coming from working with private equity companies and large institutional groups is 3% rent increase is kind of your max that you should assume. Anything over that, like private equity groups will rake you over the coal if you are telling them that you're going to get 5% rent growth 3 years out. They're not buying it. And you need to think that way as well. The best piece of advice I've ever received in terms of underwriting and deal analysis was your IRR, your cash on cash, all of it mean nothing. And this is coming from a guy who was my mentor. He started in the business the year I was born. So he saw the crash, he saw the 70s, he saw the crash of the 80s. He's seen everything. At the end of the day, can you make the mortgage payment and keep that property if something happens in the economy? And COVID was an excellent proving ground for that point, right? We can project all the returns we want, but what happens when you have an economic downturn or a pandemic event? And so that's another thing. Can this property sustain itself after IO is expired if the markets turn, if there's something that happens where it's going to put a financial squeeze on the asset.
Yeah, those performance indicators are really important. Now, in our circles, we hear stress testing all the time. And I think investors, they are used to that term and they'll ask the question, but I don't feel like they know exactly what they should be looking for all the time. So it sounds like one of the numbers that you pay close attention to would be break-even occupancy. Exactly. What other numbers are you paying attention to when you're stress testing a property? Are you changing your exit cap rates? What are you going into?
Yeah, so I'm working with the cap rate. I'm looking at both the in-place cap rate and the 3T12 adjusted cap rate. One of the other numbers I look at, is basically in that T3 scenario. Obviously, everybody's going to push their market rent before they list the deal, right? 90 days out, everybody's gross potential rents just looks beautiful. I'll circle back to the rent roll, drill down, and find all the move-ins for the last 90 days and see what they were actually leased at. Either they were leased at that market rent or they weren't. And so that gives me a level of comfort in the underwriting when I'm looking at rents. The other thing is, if there is a $150 delta between the subject rent and the comps, I'm not plugging 150 into my underwriting. I'll plug in 100 and see if the deal still works. You have got to leave that window there at all times. You've got to leave some sway room.
Yeah, I tell investors that all the time, that you don't want to maximize. There's a difference between what you think will happen and what you can underwrite will happen. You and I'm not sure about Austin, although I would surmise that rent growth has been really strong over the last 18 months. And we're probably looking at north of 5% rent growth in 2022. I mean, if we had to guess, I think in the markets we're invested in, it's going to be double digit. In your markets, it might be close to double digit. But are we going to model that? Absolutely not. Because if you model that at the front side of a project, you can totally skew your numbers. And so, there's a challenge because there's a lot of groups out there right now that maybe have cheaper capital. Maybe they're willing to get a little bit more aggressive in underwriting. But as a result, they're inflating their models. And it's becoming more and more challenging to find deals that pencil. Are you finding that dynamic playing out in your markets?
Yes, because we look for two types of assets. We have an in-house fund, and the target returns for our fund they're all unicorns. It's 20% IRR, 8-9 cash on cash. But we really want to maximize things for our investors. We're still looking at 15 IRR deals, 8 cash on cash, but it's really getting harder and harder to find deals that make sense, especially when you've got assets built in the 60s that are on the market for $130,000 a door. I won't even look at that. It doesn't make sense at all.
It's a wild world out there right now. You mentioned that sales comps are something that you really look at, Neil. I'm just curious if you've ever worked in a non-disclosure state. That might be a little wonky for some of our listeners, but there's a handful of states out there that don't disclose sales prices. So everything is it's harder to come by good sales comps. Do you have experience, and how have you overcome that, if so?
Yardi Matrix is actually a great tool. They've done a great job of getting the sales price information, having it in their system. And when you've been around for 25 years, you know people, and you can just make a phone call and, hey, between us guys, I'm working on this deal. Would you pay for yours? And they're like, don't tell anybody, but here's what I paid. So, 25 years in the business and the connections, it's kind of a great thing to have. Right. But in that, one of our target metrics too is we want to exit every deal minimum 25K higher than we came in. So all in, we've got to exit 25K higher. And that's another thing I'm looking at with the sales comps is that possible, right? Is that delta there? If the sales comps have all recently sold for 10, 15 higher than what my deal's listed for, and I've got appreciation and revenue growth in there, and I have that comfort level that we can exit at 25 a door, it's a good deal.
Yeah. So one of the metrics that you pay really close attention to is that per door sales figure. I've heard you mention that in a bunch of different contexts, but that's something that you track pretty closely.
Yes. Because it's also a good indication of where the market's going. Like I mentioned earlier, just 3 years ago, a 1996 deal was 165 a door, and now it's a 1984 deal. And I watched it happen, and I watched it happen for a myriad of reasons, but I saw it coming.
This is a little bit of a tangent, possibly, Neil. I'm just personally curious. Insurance costs have been going through the roof. And I'm sure in Texas, you guys are ahead of where we are in Colorado and Idaho. What have you guys done to combat the combination of property taxes and insurance all just shooting through the roof? It's been a distressing trend that we've seen over the last couple of years.
It's challenging. It's one of the reasons that we stay away from coastal cities. I mean, literally, like we have a deal in Jacksonville, and our insurance is just it's really heavy there. Cities like Houston, if you're close to the Gulf, or New Orleans, those cities, you're literally looking at $1,100-$1,200 a unit for insurance, if not more. I underwrite literally it's about 500 in the big four in Texas. So that's just one of the things too. It's a cost of doing business. Luckily for us in Texas, being a high in-migration state, and the people coming in are, for people coming from New York or Chicago or California, a $1,500 a month 2-bedroom apartment is music to their ears, right? $2,000 a month 2-bedroom apartment is music to their ears. And so that's kind of one of the things that continues to make some of these deals possible. But it is that the taxes, insurance, and payroll all really stress test your deal.
Yeah, and we've seen payroll just in the last 6 months to keep our high-performing leasing managers and maintenance guys. It's been a little bit more of a battle out there. We're having to push pay, 10, 12% in some cases, and really just stay current with the market. It's been a little crazy out there.
Definitely.
So we talked a little bit about underwriting, Neil, and some of the things, looking at your break-even occupancy, looking at those market comps, those sale comps. As a passive investor, one other aspect that I feel goes pretty underrated or is not looked at very closely is the property management side of things. And maybe people will ask, and hey, we're with X firm that has been in the market for 15 years. And that's as far as the conversation goes. How can passive investors truly do some due diligence on that property management partner? What things should they be looking for? What questions should they be asking when they're considering who to place their funds with?
I wish I had an easy answer there because every management company is different. I think one of the big key things when you're looking at a property management company is there's two types. There are companies that specialize in a certain asset class, and then there are those that manage all the asset classes. For those that manage all the asset classes, how good are they at it? For real, I was having lunch with a couple of investors new to the business, and they were asking me for management company recommendations. And the name of a very good management company came up, a very good management company. And my feedback to them was, go visit their Facebook page and look at the asset classes they are always promoting and talking about. We just got management of this deal. Are any of those the asset class that you're buying? Chances are it's not, right? So those are the kind of things to watch for. I mean, and there's companies, like here in Dallas is a great company that literally their wheelhouse are the properties that no one else wants to touch in high crime areas, rough clientele, and they manage those really well. So it's really about, does that property management company specialize in a particular asset class and locations, and does that align with what the property you're investing in? Is it a B deal? Are you investing in a 1965 built C deal that is going to be managed by a company who 80% of the portfolio is Class A properties? Because I'm going to be completely honest with everyone. I work for fee management companies. 70% of their time is spent on the largest client and attracting new business, right? So if you're not the largest client, you're not getting a lion's share of attention. And that's just the way it is. That's with every industry. So who's their largest client? Who's taking attention away from your deal? But again, and I'm kind of gone down a rabbit hole here, but really it's, are they experts in that asset class and in that market? Like we get approached for fee management in cities that we have no experience in. We're going to say no. We are not going to guinea pig that person's asset in a market where we don't have relationships, we don't have knowledge of the market. So you really want them to be local area experts in the asset class, and The other thing I would encourage people to do is, and this is going to sound really silly, but make a list of their properties, go to those property Facebook pages and look at the reviews and the posts and how they interact and handle reputation management. Yeah. That is a huge thing because 85% of renters will now go to a Facebook page and read reviews before they even call a property. And it's not that they're looking for bad. You can have the bad reviews, but it's how you handle those bad reviews and overcome them. Yeah. And if a post starts with a bad review and ends with the original poster saying, "All taken care of, thank you so much," then that's evident that the property management company is involved and proactive.
Yeah, people want to see activity, right? They don't want to see a ton of bad reviews and no response from management. They want signs that the management is engaged. And I think people understand too, especially in like 70s product, that you're never going to get to a 5-star rating. It's just not the nature of the property itself or the clientele. But being in the mid 3s is a really solid goal with engagement. So that leads me to a question, Neil. Every firm goes through its own life cycle. And a lot of folks that start out, in the syndication world, they're starting from zero. And so they're getting one deal, a couple deals. And then, some groups are fine with the 300 to 500 unit range, call it, but some are growing beyond that. At what point does it make sense, in your opinion, to vertically integrate? I know that your company, the REIT Group, is vertically integrated on the property management side. When does that start to become a reality or something that you should do in your life cycle as an organization?
That's a very interesting question. There's a lot of answers to that. It's going to depend on the end goal. One of the other factors is you've got to get permission from your lender to change management companies. So who on your team is the property management expert? Because they're not going to let you take management away from a sound, reputable management company for you to go ahead and guinea pig your new startup property management company. So who's your property management expert? Are you generating, between asset management fees and the property management fees that you would take in, are you generating enough to hire the level of staff necessary to effectively run those assets? If you're 3,000 to 5,000 units, you've probably got anywhere from 7 to 12 deals under your belt. You're going to need 2 regional managers. You're going to need HR and accounting. Do you bring those in-house? Do you outsource those to a third-party company? There's a lot of questions, and you've really got to sit down and write it out on paper. And then again, the other thing to ask yourself is, why are you taking management in-house? Can you really do a better job than the property management company you chose? And if they're so bad, why did you pick them? Do you really want to be a property management manager, or do you want to continue to analyze deals, raise equity, network, and build your portfolio? Because property management is death by 1,000 paper cuts. Once you veer into that lane, it's hard to get out and get back to keeping up the networking, raising the equity, analyzing deals. So you've got to ask yourself, is this what I want to do? Most people don't want to be property managers. I think they get to a point where, by bad advice, they selected the wrong management companies, or they expected that management company to treat them like they were their only client. I mean, there's a lot of reasons why a management company is a quote unquote bad management company. And some of those are, yes, they are. And the others are, you didn't underwrite the deal well to begin with, and it was doomed. But to take management in-house, really, it's going to be, you've got to have the people that know what they're doing. I mean, in the state of Texas, do you know what water, if you have a boiler system on your property, do you know what the temperature of that water has to be in the tank?
Yeah, I don't know.
120 degrees. Do you know what it has to be coming out of the faucet? 104 degrees. Are you ready to invest time into making sure that you are on top of, OSHA, EPA, state, county, city compliant, ordinances, fair housing, all of these things? It's a different animal. 2 cities in America were the first to add transgender to their list of protected classes, Tampa and Fort Worth. This was 5-6 years ago. You don't know that, and someone makes a transgender person feel offended, you're getting sued. And if that property's in Tampa or Florida, now you've got a fair housing complaint on top of it. So ask yourself, how much do you really want to be involved in that? If you don't, but you want to have more control of your assets, then you need to go find a stellar team that can do all of these things and that has that knowledge, and can spit out those numbers like I just did.
It's so heavy in operations. And honestly, it's not that profitable of a business, especially as a sponsor. If you're bringing that in-house, in my experience, you're doing that because you don't have a lot of options, or you've mastered operations and you have somebody that can head it up and kind of set it and forget it with a team. But you're going to make way more for your time and effort by going and growing your portfolio than you are by bringing that in-house, as a general rule of thumb.
Yeah, I mean, in-house management, it's like you said, it's not a huge profit business. I've got some friends that have, 14, 15,000 units. They're vertically integrated. And basically what they do with their property management profit is schmooze brokers all day.
Hey, and that money comes back 10 and 20 fold. It does.
And they built a team of operations experts, and they compensate people really well, but that's what you have to do.
Awesome. Well, as we kind of draw down towards the close here, Neil, the real estate market, highly volatile. There's a lot of conflicting signals in the marketplace. We're coming off of an 18-month bull run, basically, once we got through the spring of 2020. As you're looking forward, you guys are heavy into development, which I think is an interesting play. It's something that we're getting into at LifeBridge Capital as well. But what are you watching for on the horizon that tells you that change is afoot?
So there are a lot of people who got into syndication in a market where anyone can close a deal, right? And you've got groups out there that have literally 15 to 18 GPs. Are you making money? You've got deals that were, like I mentioned earlier, underwritten on these 4-tab underwriting models. And honestly, the main reason a lot of these people survived the pandemic was because of stimulus payments and things like Texas rent relief. Had those options not been on the table, we would have been picking up their deals in foreclosure. I think we're going to see coming ahead are people who overpaid. The free money's running out. Unfortunately, some of the residents have gotten used to not working, and you can evict me when the government says you can. So I think we're going to see people. There's a few things that are going to happen. I think you're going to see the people who didn't do their homework try to sell out their GP and exit the deal, or pretty much just get out the deal to try and save their reputation and save their investors' money. They won't be, they won't be selling for much above what they purchased. But I think there's one thing I learned from my mentor was anytime there's an economic downturn or a pandemic, there's always opportunity for people who have the capital and are ready to move forward with it. I think there are going to be people who they won't lose their properties, they won't get foreclosed on, but they're going to have to, for lack of a better term, not necessarily short sell, but sell for exit and for reputation, your reputation's sake. And I think that's where some of the groups will come in, like our group, and be able to capitalize on those opportunities, which we're already looking at doing. So I think you don't really, there's not a crash and there's not a huge downturn coming, but there is a shakeup. I always say the best thing about real estate investing is anyone can do it. And the worst thing about real estate investing is anyone can do it. So the people that come in and they keep their nose down and they learn are the people that survive, and the people that are only interested in speaking engagements and, speaking at conferences and they want to look like the expert, but they don't do the homework, are the people who are going to be buying their deals off at the courthouse steps, or if they're lucky, we'll be buying it before it gets there. I mean, honestly, I've already got a long list of properties that are on the watch list, on the loan watch list, or in pre-foreclosure. I'm watching those deals. So we can go and I don't want to say, we want to help people save their reputation. So we don't want the deal to go to foreclosure. We want to take it off their hands before they get there. But those types of things are coming.
Definitely the rising tide of the last 10 years. I think the next 10 years are going to be operations. I've said that many times on this podcast, but I think the good assets are going to flow from those who didn't have a plan to those who do and can execute on it.
Yeah, man, that's what it's been. And I mean, unfortunately, I remember being a kid taking martial arts, and there was a sign on the door that says, "He who knows watches and doesn't speak. He who doesn't know speaks." And so what I've seen is, like I said, people came in, they haven't seen an economic, a real estate cycle. And there were people who were like literally only in the business for 2 to 3 years. And the minute COVID shelter in place was announced. They're hosting webinars about how to navigate the pandemic. Meanwhile, you've got guys like Robert Faith, who literally founded Starwood and Greystar and is responsible for 700,000 units, who waited a month before releasing a statement. And who do you think I'm listening to? Who do you think we should all listen to? The guy that built 700 plus, literally 700,000 units in several countries in 23 years. I want his advice.
Yeah. And he's going to be deliberate, right? He's going to have a plan. He's going to watch the condition. I mean, it's just such a volatile situation. I did get a kick that in March 15th, 2020, we're getting webinars from newer folks trying to share what we're going to do to survive the pandemic.
Yeah. It's like, this is unprecedented, but it's, it really boils down. If I've got one really great piece of advice, I think is learn. Okay. Don't worry about being the guru. Don't worry about being the guy on stage. Yeah, it looks great, but you don't know what's going on behind the scenes. You don't know how many liens are on their properties. You don't know how many cash calls they're making. Learn, read everything you can. Take courses from IREM, take courses from the apartment association. Learn the underwriting, learn the asset management, learn the operations, learn how to monitor those operations, right? You may not want to do it day to day, but you better know what's going on. Learn.
Well, that's a fantastic place to leave it for today. Neil, thank you for joining us. If folks want to learn more about what you're doing at the REIT Group, some of the developments that you guys are working on, how can they get in touch with you?
Sure. You can reach me at Neil, Neil, at REIT Group X. So that's REIT groupx.com. You can visit us online at REITgroupventures.com. And if I'm brave enough, my cell is 972-849-5707.
Awesome. Well, hit Neil up. He's learned a lot, putting it into practice. Really appreciate you joining us today, Neil. Thank you to our listeners for joining us on another episode of the Real Estate Syndication Show. Have a fantastic rest of your day.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.